Hello everyone, and welcome to the channel. You are told a simple fairy tale. If you work, don't be lazy. Save a little, maybe invest. You will be in plus. House, car, pension, respect. The grown-up version of a Happy Meal. The structural reality is simpler and much less romantic. The modern financial system only works if you are in minus most of your life. Your debt is not an accident, it's the fuel. Here's the first number to set the scale. In many advanced economies, total debt, household, corporate, government, is now several times larger than annual economic output. Not a bit more, not slightly elevated, but multiples. That means every year, the system has to be rolled over, refinanced, fed with new borrowing just to avoid freezing. And you are not a citizen in that picture. You are a balance sheet item. And this is where the official story starts to fall apart. Because the official story says debt is a tool, you borrow to invest, you rise through the social elevator, house, degree, business. In practice, for the majority, debt is a cage that you enter in your 20s and leave, if you're lucky, right before the crematorium. The central contradiction is simple. The propaganda tells you debt makes you free, while the mechanics require you to stay trapped in permanent obligation so that someone else's asset keeps generating stable yield. Let's strip this down to plumbing. No mysticism. In the modern system, most money is created as debt. You go to a bank for a mortgage. They don't pull cash from a vault. They create a deposit for you and a loan for themselves. Two entries. Your promise to pay over 30 years becomes their asset today. On that asset, they earn interest, collect fees, and use it as collateral to raise more funding. Structurally, for money to exist and keep expanding, someone must owe. If everyone suddenly paid off all debts tomorrow, the money supply would collapse. You see the problem here, right? Here is the part economists quietly fear but rarely say aloud. A system where money is debt needs continuous, preferably growing borrowing just to stay normal. No growth in credit, and you get recession. Strong deleveraging, and you get crisis. So the machine pushes everyone who can fog a mirror toward loans. Governments, corporations, households. Your minus is not a bug. It's a requirement. Now add interest. If you borrow 100 and promise to repay 120 over time, that extra 20 has to come from somewhere. Either productivity rises enough that you create more real value, or prices rise, or someone else goes deeper into debt to keep the game going. At small scales, it's manageable. At the scale of a whole civilization, it means permanent pressure to expand, extract, grow, and pull future income into the present. That's your economic growth, a polite name for running faster on a treadmill whose speed you don't control. If you take one thing from this, let it be this. The system is not designed to get you debt-free. It is designed to get you debt-compatible. Let's zoom out in time for a moment. This is not new. In ancient Mesopotamia, rulers periodically declared debt cancellations, clean-slate edicts, because too many peasants had fallen into debt bondage. The logic was brutally practical. If everyone is pledged to creditors, who will farm, who will fight, who will pay taxes? In the Roman Republic, small farmers who couldn't service their debts lost land and ended up in something very close to slavery. That tension between creditors and citizens is as old as organized states. Whenever elites pushed the credit system too far, they got revolts, coups, or resets. The structure is always the same. Credit expands faster than real incomes. The bottom layers drown. The top layers consolidate assets. Then, either the system breaks or someone hits reset in one form or another. Legal reform, inflation, confiscation, or war. From an angle no one usually shows you, our modern world is just a more sophisticated version of this same loop, with more digits and nicer user interfaces. Fast forward to industrial capitalism, the 19th century. Workers in mining towns and factory villages are paid in company tokens, spend them in company shops, live in company housing. No credit card, but the same structure. You enter the system already owing, for rent, for tools, for food, and your labor repays the advance while locking you to the employer. The famous "I owe my soul to the company's store" line describes not a metaphor, but a balance sheet. Your minus is their control mechanism. Then comes the 20th century, middle-class dream, mortgages, consumer credit, mass car ownership. On the surface, it looks liberating. Now you can buy today and spread payment over many years. Underneath, something important flips. Debt stops being the exception and becomes the default life script. Study on credit, live on credit, get healthcare on credit, decorate holidays with credit. And the system of growth, inflation, pole, and asset prices is calibrated precisely to keep you running fast enough to service the old obligations and just hopeful enough to take on new ones. Let's talk inflation, the polite name for we quietly transfer purchasing power away from savers. Thanks. Imagine you somehow resist the debt carnival and decide to save. You cut consumption, put aside cash, think you're being responsible. In a system where inflation is almost always positive, your savings are slowly eaten. If inflation runs higher than the interest you earn, you are paying a hidden tax. On top of that, wages tend to lag behind price spikes. Asset owners with leverage tend to be buffered. Structurally, inflation punishes those who try to live within their means and rewards those who borrow to buy real assets early and pass the cost down the chain. This is the flaw you can't fix with PR. So we get the eternal circle. States borrow to fund promises they cannot cover from current tax income. Corporations borrow to boost returns, buy back shares, and acquire competitors. Households borrow for housing, education, cars, consumption. Total debt piles up. When servicing it becomes unbearable, central banks cut rates, flood markets with liquidity, rescue the system. And every rescue makes the next cycle bigger because nobody who benefited from the last boom wants to shrink. If you work in finance or industry, you've seen this movie before. You know how it ends. Not with a neat paid in full, but with someone defaulting, someone inflating, someone writing off. So, let's take a breath. Where does this leave us so far? We were promised that debt is a ladder. Use it wisely and you rise. The system we actually have needs debt to be a treadmill. You run, you sweat, you stay roughly in place while the structure above you extracts interest, fees, and control. Your plus is conditional and temporary. Your minus is permanent and systemic. And this brings us to the one number that changes the entire equation, the length of your working life. Think about it. In many countries, you start meaningful work somewhere between 20 and 30, and you're considered productive until 60 to 70. That's roughly 40 to 45 years. Now look at the standard debt products: 30-year mortgage, multi-year student loan, multi-year car leases, revolving credit lines that never quite go to zero. The system is calibrated to keep you encumbered for the majority of those 40 to 45 years. If you're lucky, you get a narrow window of relative freedom around retirement, just in time for health problems to eat whatever is left. Here's where the story stops making sense, if you still believe in the fairy tale. From your corner of Europe, does this look like strategy to empower citizens or a managed dependency system with good marketing? Let's now look at the players and their incentives coldly. States have one fundamental addiction. They need to be re-elected, or at least not overthrown. That means spending more than they collect, promising more than they can sustainably fund. Healthcare, pensions, defense, public sector, social transfers, all of that costs more than tax flows in most developed countries. Debt fills the gap. Once you rely on debt, you rely on inflation to erode it. Officially, this is sold as price stability around 2%. In practice, it's a long-term gap. Slow haircut on your savings to reduce the real value of old promises. Banks and financial institutions have an even simpler incentive: volume and yield. More loans, bigger loan books, more complex products. They earn when you borrow, when you refinance, when you roll over, when you pay fees for late payment. They also earn when your government issues bonds and your pension fund obediently buys them. They sit at the intersection of all flows and clip a small percentage on each pass. For them, a population with no debt and strong savings is a nightmare. A population in permanent mild distress, oscillating between "I'm coping" and "I need a new loan," is ideal. Corporations, especially large listed ones, live and die by quarterly expectations. Cheap credit allows them to finance share buybacks, large acquisitions, and automation instead of raising wages. Why share productivity gains with workers when you can distribute them to shareholders through financial engineering? Structurally, corporate balance sheets are wired to treat labor as a flexible cost and debt as a strategic weapon. And you get motivational posters about financial literacy and personal responsibility. From an angle no one in Brussels likes to show you, this is the real division of labor. Elites design a system where growth depends on ever-rising leverage. The top 1 to 10% own the assets that are propped up by that leverage. The bottom 90% cycle through mortgages, consumer loans, and overdrafts to keep the machine spinning. If this actually surprises you, good. That's the part nobody bothers to highlight when they talk about inclusive growth. Let's zoom out for a second. Why is it so hard to exit this? Why can't we just decide, as a society, to have less debt, more savings, lower growth, but more stability? Because the system has path dependency. If total debt is several times larger than annual output, a sharp reduction in credit would trigger mass bankruptcies, unemployment, and political upheaval. Politicians who preside over that do not get statues. So they kick the can. More liquidity, more support, more unconventional measures. From a distance, you can see the trap. Every solution that avoids short-term pain increases long-term fragility. From here, all the options are bad. The only question is who pays first and who pretends it's inevitable progress. Now let's come back to the personal level, to the why you're always in minus layer. You start adult life already owing education loans, maybe family debt, maybe a small consumer loan. Your starting salary is not calculated based on what's enough to build a buffer. It's calculated based on what the labor market can get away with. Housing is priced not on construction cost, but on how much banks are willing to lend against your future income stream. When mortgage rates were pushed down for years, housing prices were pushed up. So the same apartment costs many times your annual income, and the only way to access it is a multi-decade commitment. This is the part no politician wants to explain on TV. Low rates did not make housing affordable. They made your chains longer. Then come the usual traps. Credit cards that fill the gap between your wage and real-world prices. Buy now, pay later for phones, gadgets, furniture. Car leases that roll perpetually, so you never actually own anything that is not depreciating. Every new product is sold as flexibility. Structurally, it means you pledge larger and larger parts of your future time in exchange for short-term relief. If you work in manufacturing or services, you know the feeling. By the time the salary hits the account, most of it is already pre-assigned: mortgage, utilities, fuel, kids' expenses, loan payments. The minus exists before the money arrives. That's not mismanagement. That's design. So why does this keep going? Why aren't there mass revolts for debt cancellation like in ancient times? Partly because the control is softer. No chains, no whips, no overseers. Just credit scores, payment histories, and the quiet threat of exclusion. You can live without land in 2025, but try living without access to the banking system. No rent contract, no online purchases, no travel. Debt has become not just an obligation, but an identity filter. Trustworthy citizens are those who pay on time. From this angle, does the official story still look convincing? Let's be clear. There is nothing inherently evil about borrowing. Debt can fund productive activity, bridge gaps, spread risk. The problem is structural, when nearly everything, from public services to your basic living standard, is wired through leverage. The system gains a built-in bias toward keeping you obliged. Your attempts to break out are treated as anomalies to be corrected. Can this be changed? Technically, yes. Politically, it would require three things that modern elites hate: admitting that a large share of outstanding debts will never be repaid in full without destroying social stability, accepting lower asset prices and a smaller financial sector, rebuilding systems where savings and real productivity, not leverage, drive prosperity. Translated into normal language, asset owners would lose, creditors would lose, and ordinary people might finally get a chance to live without permanent minus. You can guess how enthusiastic the current architecture is about that scenario. So where are we, structurally, right now? We sit in a world where total debt exceeds annual real output by several multiples, where money is created as interest-bearing claims, where inflation acts as a slow-motion debt relief for states and debt erosion for citizens, where housing, education, and healthcare are priced as financial products instead of basic needs. The official narrative keeps telling you that with more financial literacy and better apps, you will beat this system individually. The cold reality is that you are trying to swim upstream in a river designed to flow the other way. From the Baltic shore, sitting in Lithuania inside this European experiment, the view is very simple. Our region is plugged into a global debt engine we do not control, and we are told to treat structural servitude as personal failure. If you caught the hidden angle here, good. If not, the elites are already billing you anyway. Thank you for watching. Take care of yourselves and your loved ones. And try to remember, slogans don't power grids. Systems do.